Howdy, y'all. Welcome to Liberty Call. Today is Thursday, February 22nd, 2024. Hope you're having a fantastical day out there. Not as pretty here in Colorado today. It's a little overcast, had a little flurries and such, but still not too bad. Not freezing or anything like that. But anyways, like I said, hope you're having a good day. I still got this bump on my head and I had to shave today. I got to take my little doggy to the vet. He has got an upset tummy. So shaving around this thing is a pain in the butt. So it's one thing to take a shower, just put a shower cap on, but trying to shave and keep this dry, not a lot of fun. Anyways, all right. Well, if it is your first time watching Liberty Call, I'm glad you're here. Thank you very much. Could you do me a favor? Yes, you in the red shirt. I see you sitting right there listening to me going, what's this guy talking about? Give me some thumbs up, like, share, subscribe, follows. Press that notification bell. Today, we're going to go through the markets, market recap, got some jobs and housing data. And then we're going to go through the Fed minutes from that came out yesterday. Woo! This is always good if you need to help falling asleep, the Fed minutes. All right, well, let's go ahead and get into today's numbers. The Dow Jones, or all the major indexes, were in a fantastical mood. The Dow Jones was up 1.18%, 456 points, closed at 39,069. S&P 500 up 2.09%, closed at 5084. NASDAQ up 2.96%. Wow, almost 3%. Closed at 16,041. The VIX fell today 5.48%. It's back down to 14.5. Canada was up 0.69. Brazil was up 0.1. And Mexico up 0.23. In Europe, Germany was up 1.47%. The UK up 0.29%. France up 1.27%. The Netherlands up also 1.27%. Spain up 0.31%. Italy up 1.06%. Was this Switzerland down 0.37%. And Portugal down 0.81%. Russian exchanges were split today. MOEX up 0.18, RTSI down 0.52. And the Asian markets, in Japan, the Nikkei was up 2.13%. Australia flat, up 0.04. New Zealand up 1.15%. In China, the Shanghai was up 1.27%. The Shenzhen Component up 0.76%. The China A50 up 0.54%. DJ Shanghai up 1.06%. Hang Seng up 1.45%. And the Taiwan weighted up 0.94%. So it looks like most of the markets were up, a percent-ish. And then like here domestically, the Dow up over 1, and then the S&P and the NASDAQ up over 2. I think from what I've seen in the news, the Nvidia stock or the earnings report was really good, and that really gave a lift to the tech sector for today. So for today, all righty. And it is a little odd. I mean, as far as the markets right now, it's like the people on TV and on Wall Street are like, everything's fine, nothing's wrong, everything's good. Same with the government. All the talking heads. Whether or not it's the Fed, or I know the Fed's not part of the government, but essentially it is. And all these people are like, it reminds me a lot of 2007, where back I was a fresh, my securities licenses were still, had, wet ink on them back then. And, the people at the time, and also I didn't really pay as much of attention to the, the media and such, back then. But, the general public had just a view of the economy and the stock market that it's never going down. I mean, you could just throw money into the market and it was just going to go up, 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 and up. And, it reminds me of a guy I had a prospective meeting with. And he worked for Shell, and he would day trade with his 401k. He would, at some point he would go all in on Shell, Royal Dutch Shell stock. And when the price would go up, and kind of peak out, he'd sell it all. And then he let it sit in cash. He'd go back down a few bucks, and he'd buy back in, and he'd go back up. And he would day trade like that. And, he asked me, he's like, well, do you think this is a good strategy? Is this something that you would recommend? I'm like, absolutely not. I mean, yeah, you're getting great returns right now, but what happens, if the market really goes through a major downturn, which I never kept in touch with the guy. So I'm curious what happened. I mean, I think the oil companies fared pretty well through 2008 and 9. I'd have to go back and look at the stock price. I mean, I'm sure they dipped, but if he left it alone, I'm sure he's all right. So, all right, well, let's go ahead and get into the today's market recap. S&P 500 hits record high as Nvidia's blowout earnings keep bulls marching on. All right, on Thursday, the S&P 500 surged to a record high, driven by Nvidia's exceptional quarterly earnings report, which surpassed expectations. Nvidia stock soared over 14%, hitting new highs as projected first quarter revenue of around $24 billion, exceeding analyst estimates. Wedbush upgraded Nvidia's price to $850, citing robust growth fueled by its data center business velocity. The positive sentiment spilled over to other chip makers like TSMC, Micron, and Intel, while Nvidia's success buoyed the entire tech sector, reinforcing confidence in AI sustained growth. Moderna also impressed with an unexpected profit in Q4, boosting its stock by 14%. However, Etsy stumbled 8% due to mixed earnings and soft guidance, highlighting challenges in the e-commerce landscape. Rivian Automotive faced a 22% decline after announcing a lower than expected 2024 production, impacting its EV demand outlook. In contrast, Royal Caribbean saw a 6% rise after raising its full-year income forecast, citing strong demand and pricing in 2024. Treasury yields surged on positive labor market data, with fewer Americans filing for unemployment benefits. This raised doubts about potential rate cuts and reinforced the Fed's stance on maintaining elevated interest rates in the near term. Federal Reserve Vice Chair Philip Jefferson expressed cautious optimism about reining in inflation to the 2% target, hinting at possible policy adjustments later in the year. Manufacturing activity accelerated in February, but services slowed, reflecting mixed economic indicators. Good stuff. So again, everyone's in a good mood right now. We shall see if this trend continues. All righty. Next up, U.S. weekly jobless claims fall as labor market remains tight. Latest report on jobless claims in the United States showed an unexpected drop, indicating continued strength in the labor market, potentially supporting solid job growth for February. This resilience in unemployment diminishes the urgency for Federal Reserve to consider rate cuts, aligning with sentiment expressed in the recent Fed minutes. We'll get to that in the next article, or in the next subject. With initial claims for unemployment benefits falling to 201,000 below economists' expectations, concerns about layoffs remained minimal. Despite high-profile layoffs earlier in the year, claims are at historically low levels, reflecting a tight labor market. Notably, decreases in claims are observed in several states, including California, Illinois, Texas, indicating a broad-based trend. The strength in the labor market is supported by rising worker productivity and an expanding economy. Despite the Fed's aggressive monetary policy stance, however, policymakers remain cautious, noting the recent job gains are concentrated in specific sectors, signaling potential downside risks to employment outlook. Yeah, and a lot of those are government jobs, which they're not real jobs. It's make-work programs, and it's essentially welfare. Financial markets reacted positively to the news, with stocks on Wall Street trading higher. Expectations for the first rate cut from the Fed have been pushed back, given strong job gains and firmer inflation readings. While inflation is expected to trend downward, concerns remain about the slowdown in the services industry, a key battleground for inflation control. In housing, there are signs of recovery. While existing home sales increased in January, buyers took advantage of lower mortgage rates. Although tight inventory persists, particularly for entry-level homes, the median home price reached a record high, indicating continued challenges for affordability. Overall, the labor market strength and nascent recovery in the housing market provide a mixed economic picture, with policymakers closely monitoring data for signals on future policy actions. That's what I think. All right, last up, we got the Fed meeting minutes. And again, if you need to help fall asleep later tonight, read this in its entirety. It is linked in the show notes. So this is the minutes of the Federal Open Market Committee from the January 30th and 31st meeting of this year. All right, get my notes up here. All right, so the first section is, where is it? Nope. First section is the developments in financial markets and open market operations. All right, during the intermeeting period, the financial markets experienced modest easing in financial conditions, although they remained tighter than during the summer and onset of the hiking cycle. Nominal Treasury yields declined, particularly at the front end of the yield curve, primarily due to a lower expected policy rate path. Expected inflation remained relatively stable, as indicated by pricing of inflation derivatives, suggesting a return to 2% later in the year. I wouldn't hold my breath yet. While broad equity prices reached new highs driven by large capitalization technology companies, broader measures of equity valuations were more subdued. Yet still prices continued economic resilience. Market participants revised their expectations for monetary policy following recent inflation data and the December summary of economic projections, increasing the likelihood of earlier rate cuts. The modal path of the federal funds rate implied by survey showed little change, but indicated an increased likelihood of earlier rate cuts, while futures base paths declined, reflecting investors' perception of more substantial rate cuts. Communications during the period emphasized the potential slowing of balance sheet runoff, with most respondents expecting a slowdown by July. Money market indicators suggested abundant reserves with effective federal funds rate remaining stable. The usage of overnight reverse repurchase agreement or on RRP facility continued to decline, indicating ample reserves, while surveillance indicated that reserves would decline at a comparable pace with the runoff of the Federal Reserve securities portfolio. The committee unanimously ratified the domestic transactions during the intermeeting period, with no intervention operations in foreign currencies. Overall, the summary reflects a cautious monitoring of financial market conditions and expectations for monetary policy adjustments amidst evolving economic dynamics. All right, next section. Staff review of economic and financial situation and outlook. During the January 31st meeting, the staff reviewed the economic situation, indicating solid growth in the U.S. real GDP in the fourth quarter of last year, albeit slower than the third quarter. Labor market conditions remained tight, but showed signs of easing, with the unemployment rate steady at 3.7% in December, and shifts in the labor force participation and employment to population ratios. However, wage growth moderated and consumer price inflation declined, though remaining above the 2%. The tightening labor market was evident in slower job gains and easing wage pressures. Despite solid GDP growth and rising exports, net exports contributed positively to growth, reflecting robust exports and tepid import growth. Meanwhile, foreign economic growth remained subdued, particularly in advanced foreign economies, with varying impacts for monetary policy tightening and energy shocks. Financial conditions eased slightly, with nominal treasury yields declining and market-implied federal funds rate paths shifting downward, indicating less restrictive policy expectations. While broad financial conditions eased, borrowing costs remained elevated, with rates declining moderately but remaining high for households and businesses. Credit conditions tightened for smaller firms, and banks reported tightening standards for commercial and industrial loans and commercial real estate. The staff's economic outlook was slightly stronger than in December, reflecting upper revisions to 2023 GDP growth. However, lagged effects of tight financial conditions were expected to constrain output growth in 24 and 2025. Inflation was projected to step down in 2024 as demand and supply aligned, with risks slightly tilted to the upside due to uncertainty surrounding inflation reduction. Risks to the economic forecast were skewed to the downside, with potential tightening and financial conditions posing a threat to real activity. Overall, the staff characterized financial vulnerabilities as noted, with asset valuation pressures remaining high relative to fundamentals, particularly in housing and commercial real estate. Leverage in the financial sector was notable, with banks vulnerable to interest rate increases, and funding risks remained elevated. While uncertainty persisted, risks around the baseline economic forecast had diminished over the past year, although inflation risks were slightly lower to the upside, and downside risks to real activity remained. All right, the participants' views on current conditions and economic outlook. Participants in the January meeting of the Federal Reserve discussed current economic conditions and the outlook, noting solid expansion in economic activity, with GDP growth above 3% for the fourth quarter of the previous year. Despite moderating job gains, unemployment remained low and consumption continued to grow. However, inflation, though easing, remained elevated. Participants viewed the current pace of monetary policy as restrictive and expected it to continue exerting downward pressure on economic activity and inflation. However, with more favorable inflation data and ongoing improvements in supply conditions, they saw risks to achieving the committee's goal as moving into better balance, although they remained vigilant about inflation risks. Regarding inflation, participants noted its decline over the past year, but expressed concerns about its persistence elevation above the 2% target. While recent improvements in headline and core inflation were acknowledged, participants highlighted idiosyncratic movements and indicated a need for more careful assessment of incoming data to judge if inflation was sustainably moving towards the target. In their discussion of the household sector, participants observed strong consumer spending supported by low unemployment and solid income growth. However, some noted signs of financial pressure on low and moderate income households, posing downside risks to the consumption outlook. Reports from business contacts varied across industries and districts, with some expressing optimism about economic prospects, while others reported mixed or weakening activity. Labor market conditions were generally seen as tight, with job gains moderating but still strong and wage pressures easing in some areas. Participants highlighted the uncertainty surrounding the economic outlook, noting both upsides and downside risks to the inflation and economic activity. Momentum in aggregate demand and potential less restrictive financial conditions were cited as upside risks, while downside risks included geopolitical developments, negative spillovers from foreign economies, and weakening household balance sheets. Regarding financial stability, participants noted receding risks to the banking system, but identified vulnerabilities at some banks, including funding costs, reliance on uninsured deposits, and exposure to high commercial real estate. They emphasized the importance of monitoring liquidity conditions and improving the operational efficiency of the Federal Reserve's discount window. All participants agreed to maintain the target rate for the federal funds rate at 5.25% to 5.5%, judging it to be appropriate given current economic conditions and their implications for the outlook. However, they indicated that the policy rate was likely at its peak for this tightening cycle, with future decisions contingent on incoming data, the evolving outlook, and the balance of risks. All right, so they decided to leave it alone. And committee policy actions, the FOMC held its, we already know that. They assessed the risks. To support maximum employment and achieve a 2% target over the longer run, the FOMC decided unanimously to maintain the target at 5.25% to 5.5%. They agreed to carefully assess incoming data and the evolving economic outlook and risk before considering any adjustments to the target range. The committee affirmed its commitment to returning inflation to the 2% objective. Members agreed to continue reducing the Federal Reserve's holdings of Treasury securities and agency debt and agency mortgage-backed securities, as previously announced. They emphasized the importance of monitoring labor market conditions, inflation pressures, financial developments, and international factors in determining the appropriate stance of monetary policy. Whew, that's a lot. And they basically, there's a lot more here. So they just have decided that they're going to leave things alone. That's pretty much what it says. So if you want to go back and read it in its entirety, it is a quite a long read. So basically, the Fed is leaving things alone. They're gonna be cautiously optimistic about getting down to that 2% target. They hope it happens this year. I'm a little skeptical of that personally, but we shall see. So, all right. Well, that's everything that I had for today. If anyone needs anything from me, please go to, where is it? Where's my overlay? It's gone. All right. Well, go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful evening, and I shall talk to you next time. Adios.